The government just told you inflation is going down. The headlines confirmed it. The economists celebrated. Wall Street threw itself a small party, and you stood in the grocery store checkout line, looked at your total and thought, that can't be right. But it is right. The number is real. Inflation is technically falling. So why does every single purchase still feel like a negotiation you're losing? The answer isn't what most people think. It isn't political spin. It isn't media manipulation. It isn't even your memory playing tricks on you. It's something more structural,
This is
more
all I
permanent,
have.
and
It's not
far
enough.
more uncomfortable.
Fine, take it
Today
all.
we're going to pull back the curtain on one of the most misunderstood economic gaps of modern life. The distance between what the data says and what your wallet actually feels. The misunderstanding at the center of everything. Let's start with the word people throw around most: inflation. Most people hear inflation and think it means prices are rising. That's not wrong, but it's only half the picture, and the missing half is where all the confusion lives. Inflation, technically, is the rate at which prices are rising. Not the level of prices, the rate. Think of it like a car accelerating down a highway. When someone says inflation is falling, what they mean is the car is no longer accelerating as fast. It is still moving forward. It is still covering ground. It is still pulling further ahead of you every single day. Slowing acceleration is not the same thing as stopping, and stopping is not the same thing as reversing. When inflation falls from 8% to 3%, prices are still going up, just more slowly. Everything you paid for last year costs more this year. Everything this year costs more than last year. The scoreboard keeps moving. The rate of scoring just slowed down. This is the first crack in the story. The headline, "Inflation is falling," is technically accurate and practically misleading at the same time. Because what people actually feel isn't the rate. They feel the level. And the level never went back. The price floor that doesn't move. Here's the part that doesn't make the news cycle, but probably should. When inflation surged from 22-1 through 22-3, prices didn't just drift upward, politely. They jolted. Groceries, rent, energy, insurance. Some categories moved 20, 30, even 40% inside of 2 years. And when inflation cooled, those prices didn't follow. They settled at their new elevated position and stayed there. This is called price stickiness, and it's one of the least romantic but most important concepts in economics. Prices are far more willing to climb than they are to fall. Companies raise prices when their costs rise. When those costs eventually ease, they do not always pass the savings back. Margins expand quietly. The customer absorbs the new normal. Think about what happened to eggs in 2022. A combination of supply chain disruption and the worst avian flu outbreak in American history sent egg prices up over 100% in some markets. Then the crisis eased, supply recovered, egg prices came down, but not to where they were. Not even close. That gap between where something used to cost and where it settled. That gap is permanent. And across hundreds of categories simultaneously, that gap is your entire lived experience of the economy right now. The inflation story ended. The price story didn't. Wages chasing a shadow. This is where it gets personal. One of the first things economists point to when inflation rises is wages. The labor market tightened. Workers gained leverage. Pay increased. And this is true. Wages did rise during the inflationary surge. The problem is sequencing. Wages followed prices. They did not lead them. By the time your paycheck adjusted, groceries had already moved. By the time you negotiated a raise, rent had already reset to a new lease rate. By the time your industry caught up, the damage was banked. And for tens of millions of workers, wages never fully caught up at all. The math is straightforward. If prices rose 15% over 2 years and your income grew 6%, you experienced a real pay cut disguised as a raise. The number went up, the purchasing power went down. Now layer on top of this something behavioral economists call hedonic adaptation, or more accurately in this context, its painful opposite, Humans are remarkably good at adjusting their expectations upward. When things are good, we normalize good quickly. When things tightened, we feel every reduction acutely, but we struggle to lower our baseline reference point for what things used to cost. Every trip to the store is measured against what you remember paying. That memory doesn't update just because the government changes its benchmark. The number on your paycheck looks better than it did 4 years ago. The number in the checkout line looks worse. Both can be true at the same time. And both are the categories that hit hardest and never let go. Not all inflation is equal, and this is critical to understanding why some people feel the pinch far more sharply than others. The Consumer Price Index, the official inflation measure most headlines reference, is a basket. It aggregates thousands of goods and services into a single number. When that number falls, it means the average across the basket is slowing. But you do not live inside an average. You live inside your specific spending pattern. And your specific spending pattern almost certainly over-indexes on the categories that never really came back down. Housing is the most obvious example. Shelter costs represent the single largest expense for most households. And shelter, unlike eggs, unlike gasoline, unlike used cars, has its own delayed reaction problem. Rental prices are locked into lease agreements. The CPI measures housing costs using something called owner's equivalent rent, which lags real market conditions by months, sometimes longer. So when the real housing market was ripping higher in 2022, the official data was still catching up. And when the market started cooling in 2003, the official data was still registering the earlier surge. The numbers always seem to be telling yesterday's story. Then there's insurance, auto insurance, home insurance, health insurance. Across the board, premiums have climbed in ways that feel disconnected from the broader inflation narrative. Why? Because insurance companies price based on their own costs. Claims, legal settlements, construction replacement costs, medical care. And those costs built up quietly through the pandemic and are still being baked in today. You can fill your car with gasoline that costs less than it did 2 years ago. Then you can pay an insurance premium on that same car that costs significantly more. Both of those things exist simultaneously in the data. Only one of them feels like relief. Services broadly, dining, childcare, healthcare, personal care, have remained stubbornly elevated because services are labor-intensive, and as wages rose, service businesses passed those costs forward. Unlike physical goods where supply chains eventually normalize, human labor doesn't just suddenly get cheaper. The psychology of a moving baseline. There's a concept in behavioral economics called the reference point. It's simple, but it explains a great deal. Humans evaluate almost everything not in absolute terms, but relative to an anchor. The anchor for financial decisions is almost always the last price we paid for something, or the price we believe something should cost. For most working adults, that anchor was set sometime between 2018 and 2020. A grocery run felt like one number. A tank of gas felt like another. A dinner out had a particular price range. Those anchors are still embedded, neurologically, practically, in how we evaluate every purchase today. When current prices are significantly above that anchor, the brain registers it as a loss, not as a cost. As a loss. And loss aversion, one of the most documented findings in all of behavioral science, means losses hurt roughly twice as much as equivalent gains feel good. This is why falling inflation doesn't feel like improvement. Falling inflation is the economy saying the wound is closing. Your brain is still feeling the wound that opened. There's also a compounding factor that rarely gets discussed: shrinkflation. Prices didn't just move on the label, the product itself quietly changed. The bag got lighter, the container got smaller, the portion shrank, the quality of ingredients shifted. You're paying more or the same for genuinely less. This is almost impossible to measure accurately. It doesn't fully show up in official data, but it registers psychologically because when you open a package and think, "This used to be bigger," you're right, it was. And the price didn't reflect the change. Falling inflation cannot address shrinkflation. The two exist in entirely separate accounting systems. Interest rates, And the slow motion trap. There is one more layer here that operates on a longer timeline and hits harder than most people expect, until it's already happened. To fight inflation, central banks raise interest rates. This is the standard playbook. By making borrowing more expensive, they slow demand. Slower demand means less pricing pressure. And eventually, inflation eases. It worked, more or less. Inflation came down, but interest rates didn't immediately follow. They moved slowly, with intention, because cutting too fast risks reigniting the very inflation they just suppressed. The practical consequence of this is that millions of people are now experiencing the full cost of this fight, in the form of mortgage rates, auto loan rates, credit card rates, and small business borrowing costs, all of which are significantly higher than they were 3 years ago. A home buyer in 2020 locked in a mortgage somewhere around 3%. A home buyer today might be looking at 6 to 7%. On a $300,000 home, that difference in monthly payment is substantial. It can push ownership out of reach entirely. It is keeping people in rentals. It is keeping rentals overpriced because demand there remains high. It is locking existing homeowners in place, reluctant to sell and surrender their low rate, which restricts supply further and keeps prices elevated. So you have the original price inflation, layered on top, rate-driven affordability destruction. Layered on top of that, a frozen housing market that can't correct properly because nobody wants to move. 3 separate mechanisms, all pointing in the same direction, all hitting the same household balance sheet. Falling inflation eases. One of those, 3. 2 remain fully intact. What actually restores the feeling? Here is the uncomfortable truth that most economic commentary avoids. The feeling of affordability doesn't return simply because inflation falls. That headline is the beginning of a long process, not the resolution of one. For things to genuinely feel better, 3 things need to happen over time. Not simultaneously, not quickly, but progressively. First, wages need to sustainably outpace prices for an extended period. Not one quarter. Not one strong jobs report. Years of real income growth that builds a buffer between what people earn and what their essential expenses cost. That process is underway in some sectors but nowhere near complete across the broader workforce. Second, some of the stickiest cost pressures, primarily shelter, need to actually moderate rather than just slow their acceleration. This means housing supply has to increase meaningfully. That is a slow-moving, politically complicated, locally dependent process with a decades-long backlog. Third, interest rates need to fall far enough and stay low enough that the affordability math on large purchases improves structurally, not just marginally. Enough to unlock the frozen market dynamics that are keeping supply constrained and demand suppressed simultaneously. None of these things happen because a headline says inflation is falling. They are downstream of that headline by months, sometimes years. The data has improved. The experience hasn't caught up yet. And being honest about that gap, rather than pretending the headline represents the whole story, is where real financial clarity has to begin. In 1971, when Richard Nixon closed the gold window and untethered the dollar from any physical constraint, a monetary philosopher named Friedrich Hayek wrote something that has aged uncomfortably well. He argued that inflation, once it takes hold in the minds of ordinary people, changes behavior in ways that take far longer to reverse than the inflation itself. He wasn't just talking about prices. He was talking about expectations, about trust, about the quiet recalibration of what people believe is possible for their own financial lives. Prices move faster than confidence, and confidence, once shaken, confidence that your savings will hold their value, that your income will keep pace, that the math of daily life will eventually work in your favor again, takes longer to rebuild than any central bank timeline accounts for. So when someone asks you why everything still feels expensive even though inflation is falling, the honest answer is that the data and the feeling are measuring different things on different timelines. The data measures the rate of change. The feeling measures accumulated loss against a remembered baseline. And accumulated loss doesn't reverse simply because the rate of new damage slows. The scoreboard stopped moving as fast. The score didn't change. And somewhere between those two facts lives the economic reality that most headlines don't know how to hold at the same time.